The next question is what I probably see the most, and that is, what's the best HYSA? And the answer is, so I've spent hundreds of hours over the last few years diving deep into financial products through research, testing them out, and breaking them down in these videos for you. And I've noticed that, especially on my videos for HYSAs, I tend to get a lot of repeated questions. And that's led me to create this video here today where, ideally by the end, you'll be able to answer any question you may have about HYSAs. If you're new here, this is Feasible Creative, where we help you unlock financial freedom. So let's go. Number one, what's an HYSA? This stands for high yield savings accounts, and these have risen in popularity in recent times as a safe alternative to the traditional savings accounts. These are the accounts where you get in your car, drive in, and maybe meet with a bank teller, deposit a check, withdraw money. That's sort of the old school way of banking. HYSAs are the new school, or the more modern way. They're called high yield because they offer a higher interest rate, or APY, on the money that you deposit into your account. Said another way, if you deposit money into an HYSA, you get paid more interest. And that's largely why they've become so popular, because people, of course, want to make more money. You may be wondering how you can get paid more with these types of accounts, and what do they do differently? The answer is that they're often online only, so these fintechs or these banks, they don't have to pay for any physical locations or bank tellers or any overhead like that. As a customer, these savings are partially passed on to you. You may have heard this term before, but it might have you asking, what is APY? It stands for annual percentage yield. It's a percentage that shows how much interest you'll earn on your money after 1 year, including compound interest. Compound interest is the phenomenon that helps your money grow much faster. You have your initial deposit amount, you'll earn interest on that, and then you'll earn interest on top of interest, and really have this snowball effect going on as time progresses. For example, if you deposit $10,000 into an HYSA with 4% APY, after 1 year, you can expect to have about 10.4K. Now, this assumes that you don't withdraw or contribute anything else, and that this 4% APY is consistent. In reality, the interest rates will always fluctuate from time to time, but for the sake of this example, just to demonstrate how much money you could be making. Now, to compare things versus the traditional bank account, where you might make 0.01 or 0.05%, the difference in what you get paid in 1 year is significantly different. I also want to call out that most accounts compound interest daily, but you actually get paid the interest amount into your account once a month. By the way, if you're getting any value out of this video, please hit the like button and subscribe. And as a thank you, there's a link in the description for my completely free budget template. So now you understand the main appeal of these HYSAs, but you might be wondering if it's too good to be true. Next question, are HYSAs safe? Yes, as long as they're with a legit FDIC insured institution. And I'll explain more on this in a moment. You have to remember that when you get an HYSA, you're not putting money into the stock market or buying bonds or any form of investing. You're literally just taking your money and depositing it into a bank account. So what is FDIC insurance? It stands for Federal Deposit Insurance Corporation, and this is an independent agency of the US government that works to protect you from the unlikely event of a bank failure. Your deposits are automatically insured to at least $250,000 per depositor per bank when you're using an FDIC insured bank. There are also joint accounts that offer $500,000 in FDIC insurance, and that's $250,000 for you and $250,000 for another individual. Any dollar above these limits is technically at risk, although the likelihood of a bank failure is extremely slim. At this point, you understand the main background, but you may be wondering, how do you access your money in an HYSA? To answer this, I have to say that it depends on the HYSA you choose. There are some examples like Marcus by Goldman Sachs, which only offers a savings account portion. There's no checking account. So if you want to access this money, you're going to have to take it from your Marcus account and externally transfer it to another bank to either withdraw the funds or spend it as you will. On the other hand, if you take SoFi, this account does offer both a checking and savings account. So you can have your money in a savings account, get paid out that high APY as an HYSA. But then when you want to spend money, you can take it from the savings account, put it into your checking account, and then use a debit card, tap to pay, or anything like that. Next up, are there limits on how often you can withdraw money from your HYSA? The answer is no. Previously, there was a withdrawal limit of 6 per month, but in 2020, that was actually removed. And at this point, there are no limits across virtually every HYSA. Another question I see a lot is, how long do transfers take? And again, this depends on the HYSA you choose. There are really two types of transfers. There's internal and there's external. The internal movements tend to be instantaneous. Like with SoFi, you can take your money from your checking account, put it into your savings account. So transferring it internally within the same bank or within the same fintech. On the other hand, for external transfers, these tend to take 1 to 3 business days. And this is where you have your HYSA, take money from here, put it into an external bank, or alternatively, have money in an external bank and put it into your HYSA. Again, it's hard to answer this question 100% because it does depend on which HYSA you choose. Now we have, why do APYs change? The short answer is the economy. The more detailed answer is that banks use what's called the federal funds rate set by the Fed or the Federal Reserve as a benchmark rate to guide what they have as APYs for their HYSAs. This rate is also a tool that the Fed, or the central bank of the US, uses to try to control inflation as much as possible. You may have seen in the news that the Fed tries to raise interest rates to help bring down inflation, which is just rising prices. So typically when the Fed lowers rates, APYs on your HYSA will lower as well. Then when the Fed raises rates, APYs on HYSAs tend to increase. The next question is what I probably see the most, and that is, what's the best HYSA? You've probably seen the videos on YouTube where people are pointing and trying to promote different HYSAs. In my eyes though, at the end of the day, these are all virtually the same thing. You take your money, put it into this account, and earn higher interest. I will say though, there are some nuances that you'll want to consider. Like I mentioned earlier, Marcus only has a savings account. If you look at Wealthfront, it's technically a fintech, it's not a bank. There are a lot of different details that you will want to know before diving in. Now, there are a few factors I suggest considering when looking for the best option for you. The first is trust. You want to find a name that you're familiar with, that has good reviews. Maybe it's a bank you used in the past. And secondly, I never suggest chasing the highest APY. Reason being, the APYs change over time. The difference between 4.4 and 4.3% isn't going to be enough to make a difference if you don't like the rest of what this institution offers. The last thing to do is make sure you are depositing money into a place that is FDIC insured. Next question for HYSAs, what's the difference between a bank and a fintech? The fintechs are financial technology companies, and these tend to partner with banks in the background. They generally have better UI, better functionality, but you're sort of 1 degree removed from the bank itself. Now, one of the pros of using a fintech is they can have a higher FDIC insurance amount. And this is because these institutions often use a cash sweep, where essentially your money is deposited and then spread across a bunch of partner banks. So each one of these banks has $250K in FDIC insurance. They all partner together and each have a portion of your savings. Some pros of fintechs though are that you often will get a higher APY, you'll get a higher FDIC insurance amount. But the cons, they're really never physical locations like most HYSAs. And also these tend to be less established, so you're not working with a bank that's been around for 100 years. It's often something that's new and up and coming. Next we have, do you have to pay taxes? As a disclaimer, I'm not an accountant, but the answer is yes, as long as you've earned at least $10 in interest in any given tax year. HYSAs are taxed at a federal level and often a state level depending on where you live. And during tax time, you'll get a 1099 INT form or interest form. This is pretty straightforward. For me, it just has one box showing the amount of interest I've earned. I'll input that amount and see how much I owe in taxes. Keep in mind that you won't owe taxes on your account balance in total. It's just on the amount of interest that you've earned. For your own situation, you'll have to meet with an accountant or do some deeper research depending on where you live, but you will have to pay some taxes more than likely. Next, we have, what's the difference between an HYSA, a money market account, and a CD? An HYSA, you know at this point, but it's a high yield savings account. It's a place where you can deposit your money, earn high interest, generally online only. CD stands for certificate of deposit. And this is a little bit different. It's a spot where you essentially put a fixed amount of money for a fixed period of time, and you get paid interest during that time period. Now, you're not supposed to withdraw anything early or you'll have some penalties. And for doing that, you get typically paid a higher interest rate versus an HYSA. A money market account is extremely similar to an HYSA, but one of the nuances is you can often write checks. And also there tends to be minimum balance requirements, which is something that most HYSAs don't have. Final question is, insert year, too late to open an HYSA? And the answer is no. Interest rates will fluctuate. Maybe now they're high, maybe in the future they're low, but in general, they will always be higher than the traditional savings accounts because those rates also fluctuate. I find them to be an awesome place to store money for an emergency fund, or if you're looking to buy a car, buy a house, a great place to safely store your money and earn some interest while you do it. Hopefully this answered most of your questions, but feel free to leave any more you have in the comment section below. Also make sure to watch this video next.